welcome to The Trade. Before we get into the charts that matter, let's have a quick look at what traders are watching out there. President Trump to exempt automakers from his punishing 25% tariffs on Canada and Mexico for 1 month, as long as they comply with an existing free trade agreement. Trump also reportedly considering exempting certain agricultural products from tariffs imposed on Canada and Mexico. Price premiums for aluminium on the physical market in the US have surged to a record high due to the looming threat of tariffs on imports of the metal used in the transport, construction and packaging industries. Trump planning to restore 25% tariffs on aluminium imports from the 12th of March. US corn, soybean and wheat futures closed higher on Wednesday, bouncing from multi-month lows set a day earlier as indications that US tariffs against Canada and Mexico may be reduced, helping ease market jitters over those escalating trade tensions. And the US has paused intelligence sharing with Ukraine, according to the CIA Director John Ratcliffe, piling pressure on Ukrainian President Zelensky to cooperate with US President Trump in convening peace talks with Russia. Meanwhile, the ECB set to cut interest rates again later Thursday in what is likely to be its last easy decision for a while, as trade wars and rearmament drive the continent's biggest economic policy upheaval in decades. Well, let's get into the technicals now. Carly Garner from DeCarlyTrading.com expressing concern over the current gold market, citing historical patterns from 2011. She sees signs that gold might be entering the last stage of its rally, with potential risks emerging as momentum appears to slow. Olivia Grace Curran caught up with Carly a little earlier.
Hey, all three charts that I'm going to talk about are going to focus on gold. It's a commodity market that's obviously getting a lot of attention. There's a bit of a gold rush, so to speak. The majority of people that I talk to are bullish, and most of them are even long the market. But I'm here to wave a red flag. I think that we're probably getting into the last stage of the rally, and there could be some danger ahead. I've seen this movie before. In 2011, we had very similar overweighted sentiment, very similar price patterns, and almost parabolic trading, and it didn't end very well. And I have a feeling we might see a repeat here in 2025. And so what I'm looking at is the relationship between gold and silver, gold and treasuries, and then outright gold. The first chart that you've got up here is a weekly chart of gold futures. And you can see there's a trend line, some technical resistance that comes in around 2950. Honestly, 3000 is kind of a psychological area. So I can't rule out a pump up to somewhere around 3,000, maybe even a little above, but somewhere in this general ballpark, we start to get really top heavy. When I look at the RSI, you can see at the bottom of that chart, the RSI is the relative strength index. You can see that despite the fact that gold has made new highs on this last run, the RSI has not. And that's usually a sign that momentum is waning, despite the fact that prices are still accelerating higher. So it's kind of a warning flag to me that perhaps most of the buying is probably behind us, and we might run into a situation where we just simply run out of buyers and then prices start to fall back on themselves. Now, if we get below 2,800, that kind of gives the bears a bit of an edge. A normal pullback would put us around 2,600. So 2,600 is normal back and fill. It keeps us in a bull market. But if we break 2,600, honestly, I don't see anything stopping it until we get to about 2,150. And I think that would probably be a little scary for somebody that's holding gold here at these high levels. Keep in mind, in 2011, when the market peaked roughly around 2000, it fell 45% over the next 2.5 years. And so it's not out of the question to see a repeat of that. I know that's not on most people's bingo cards, but it's very possible. And if we did see something like that, we're talking 1,600 gold again. So be very careful. If you've made some money on the upside, might be time to move it into something that's a little less overbought, a little safer, perhaps treasuries. And that's possibly the next chart we're going to look at.
Okay, yeah, let's take a look at the treasuries.
Okay. So the idea of this chart is we're seeing a very wide spread between gold and treasuries. And I'm talking about US treasuries, and why that matters is there's basically 3 assets you can go to if you're trying to put money somewhere where you feel it's safe. Gold is considered a safe haven, but historically gold can be very volatile, just as I just explained. Treasuries also are considered a safe haven, so they compete with each other. The big difference is gold does not pay interest or dividends, treasuries do. So if you look at this chart, you can see that treasuries are actually undervalued compared to recent historical norms, while gold is overvalued. And so if I'm somebody that has money to put into a safety asset, I'm probably going to choose treasuries. I'm going to earn 4 or 5% on my money while I wait and see what happens. If you're in the gold market, there's no risk buffer. You're not bringing in any cash flow, no interest. So if you buy at 3,000 and it drops to 2,100, again, that's kind of not saying it's going to happen. I'm saying it's possible. You have no risk buffer because you're not bringing in income. It's pure risk. So it's actually really not a safety play at these prices, in my opinion.
Okay, so what would be your advice at the moment? It looks like gold is obviously still doing quite well with all the tariff uncertainty. Should people hold?
I don't think so. If you do want to hold for the long haul, if you're one of those people that want to hold gold forever, that's fine, but I would encourage you to hedge because there is definitely some downside risk. The third chart that I was going to talk about is the relationship between gold and silver. And you can see that gold has been outperforming silver. And the overwhelming narrative that I read and hear about is people expect the gold market to the silver market to catch up to gold, meaning that gold's undervalued and gold should rally. But we saw this same scenario in 2011, which is right before we went into the metals bear market. In that situation, it was gold that was, it was silver that was outperforming gold. So it's a very similar dynamic here. The opposite is outperforming, but I think the outcome is going to be the same. I think instead of silver catching up to gold, I think what's going to happen is gold is going to start to weaken and silver will sell off as well. And I think we go into another bear market in the metals. And if that happens, we may very well see silver outperform gold as that spread comes into a more natural state. But that doesn't necessarily mean silver goes up. It probably means silver goes down less than gold goes down.
And you mentioned in your notes that gold is pretty and humans assign it with value, but at the end of the day, it isn't entirely practical.
I talk to a lot of investors that are sitting on gold bullion. Meaning they're holding the physical metal. And you know what? If you're holding a small amount, if you've got a couple bars or a couple of coins, it's no big deal. You can easily sell those. You can go down, most decent sized towns have stores that allow you to do that. You can do it by mail, but it's expensive to ship. But the reality is if you're holding a large amount of physical metal, it's really hard to unload that. You might have to find multiple buyers. It's just a tough market to sell when you're ready to sell. So I personally think that there's a time and a place for gold. I just don't think it's now. Everybody that I talk to, like I said, is overwhelmingly bullish gold for all the reasons that we know are out there: uncertainty, inflation, all those types of things. But I heard these stories in 2011 with the exact same chart pattern, and it didn't end well. So again, I'm not telling everybody to go sell their gold, but you can hedge your gold. If you have access to a futures market account, you can either sell futures against your gold holdings to hedge your price risk, or you can sell calls and buy puts. But there are ways to protect yourself because gold has been going up for the last couple of years, but it wasn't that long ago gold was a dog. In fact, it was just 3 or 4 years ago, gold was a complete dog. Now it's a darling. Markets go in cycles.
And it took around a decade for gold to appreciate from $2,000 to $3,000. So what if gold goes to $4,000, and how long would that take?
Well, I mean, we don't know what we don't know, but there's some, I'm met with resistance when I tell people that maybe they should either take profits or protect their prices in gold. For this reason, that a lot of people are looking at 4,000, 5,000, because if you adjust for inflation and these sorts of things, that's the math that spits out at them. But again, we've seen this before, and it took gold topped out at around 2000 and 2011 and sold off pretty sharply from there. And as you mentioned, it took a decade to get back. So even if it does go to 4,000 or 5,000, I'm not convinced it will anytime soon, but it might. I could be wrong. But if it does, maybe it's how it gets there is more important than whether or not it gets there. For example, if it goes to 4,000 right away, then kudos. Anyone that was long made a lot of money. But if it takes 10 years and is 45, 50% drawdown before it does it, that's a whole different story. I'm not sure it's worth the pain and the risk to be long gold at these levels.
All right, Carly Garner there speaking to Olivia Grace Curran a little earlier. That does it for this edition of The Trade. Be sure to join us again next time.